What is the difference between a short sale and foreclosure? Both short sales and foreclosures involve lenders, which can cause confusion. However, it's important to dispel any myths or misconceptions. It's possible for someone to be in foreclosure without being foreclosed on yet. Let's start with the explanation of a short sale. A short sale occurs when the lender accepts a sale price that results in a loss for them, but the homeowner still retains ownership of the property. This typically happens when the homeowner is behind on payments and may be in foreclosure proceedings. However, the bank has not yet foreclosed on the homeowner. During a short sale, the homeowner still has rights and can decide what to do with the property until the foreclosure is finalized. If the homeowner decides to sell the house but has no equity, the lender becomes involved. It's important to note that the lender is not responsible for deciding whom the homeowner sells the house to. Another misconception is that all offers need to be presented in a short sale. The homeowner signs off on the offer, and the bank has specific requirements for accepting offers, such as the offer price and minimum net. The final decision of whom to sell to rests with the homeowner, and if the bank doesn't agree to the terms, they can reject the offer. Now, let's discuss foreclosure. In contrast, foreclosure occurs when the bank forecloses on the homeowner, and the bank becomes the seller. The property becomes an REO, real estate owned, foreclosure property. In this case, the bank determines the terms of the sale since they are accepting less than what is owed. The bank holds the first position lien, making its claim superior to other liens. During negotiations with other liens, such as HOA or secondary liens, the bank determines the amount these subordinate liens will receive since they are the ones taking the loss. If the bank forecloses, all other liens below them are wiped out. After a homeowner is foreclosed upon, the bank conducts due diligence and hires a real estate agent to check if the property is occupied or vacant. If occupied, the bank may attempt to negotiate a cash for keys agreement with the homeowner, where they offer cash in exchange for the keys and an agreement to clean the house. This approach helps ensure that the homeowner doesn't damage the property, and it is a less expensive alternative to eviction. If the house is already vacant, the bank proceeds with a title search to resolve any liens or lawsuits clouding the title before selling the property. The foreclosure process timeline can vary, typically taking 45 to 60 days or longer depending on factors such as occupancy and state regulations. Once the property is vacant and the title is clear, the bank hires 2 agents to perform broker price opinions, BPOs, to assess the value of the property. The bank then determines the list price based on these assessments. So, to conclude, the terms foreclosure and pre-foreclosure are used to indicate the status of the foreclosure proceedings and whether a sale date is imminent. Understanding the difference between a short sale and foreclosure is crucial when dealing with these situations. A short sale involves the homeowner selling the property at a price that results in a loss for the lender, but the homeowner retains ownership during the selling process. In contrast, foreclosure occurs when the bank takes ownership of the property and becomes the seller. It's important to consult with professionals and seek expert advice when navigating these processes. Real estate agents, foreclosure attorneys, and financial advisors can provide guidance and help homeowners or potential buyers make informed decisions based on their specific circumstances.